All right, now that we talked about venture capital in general, looking to get a little bit of just quick background on how you kind of made your moves going from college nerd to venture capital employee.
Yeah. So again, I've said this probably about a few times at this point, but it was a non-linear path that looks linear when you look backwards. I, for a number of reasons, realized that I might be interested in investing, that it scratched that itch of thinking about strategy and holistically about businesses in a way that I found really fascinating. And so, the first thing I did from there was go talk to people that were currently in seat. And so for anyone thinking about, would I want to dive into this industry? Do I want to pursue this job? What I really want to do? The easiest and fastest way to figure out if something is for you or not, or how to get there, is to go talk to people that are currently doing that thing. And so that's what I did. I talked to investors across a lot of different dimensions. Some of them VC investors, some of them private equity investors, some people at hedge funds, just everyone you could think of that somehow got to a seat that I thought might be interesting. And the common thread across most of those conversations was that it is very hard to get into a pure investing role straight out of undergrad, which makes a lot of sense, right? Your investing ends up needing to be a very wide-ranging role where jack of all trades, master of none. You need to know a lot about what makes businesses tick and how to think about what they can become. And that requires experience on the job and doing other things. Pretty much the overarching advice that I got from everyone I talked to was, go figure out something else to do first. It was possible to go to an investing firm out of undergrad, but those types of roles typically, they were very sourcing heavy roles. It would be, hey, you're going to pick up the phone, you're going to dial up places, try to find potential investment opportunities, and then from there there's a chance that you graduate, so to speak, into a full stack investor role where you're actually involved in the decision making as well. The alternative path that I think a lot of people take, and it's a well-trodden path, and it's exactly what I did, was to take an interim step through investment banking. So I was very late to the game, actually, especially compared to the way that investment banks recruit nowadays. It is, and Alex, we've talked about this previously, truly a ridiculous recruiting funnel. It starts exceptionally early in a lot of cases in college careers of, hey, you're a freshman, you're a sophomore. Start thinking about wanting to do this eventually because you're getting recruited for your junior year internship to then get a return offer to go back there after graduation. It's ridiculously early, but that's kind of what the arms race of hiring talent has become for investment banking. For anyone that's hearing this that is after that point, that is panicking, don't panic, because...
What, you mean you didn't figure out perfectly when you were 19 years old exactly what you wanted to do?
Yeah, you haven't been preparing since kindergarten for this. You're way late to the game. You might as well just give up now. I also did not know about this, well-trodden funnel into investment banking. I picked up my head in fall of junior year thinking I was relatively early to the game, and I was like, I should figure it out by junior year spring, right? Wrong. But I still managed to get, one of the last, call it investment banking boats out there. It was a small firm up here in Boston called Eris Partners, focused exclusively on technology companies. And this is probably a good time to pick apart what exactly investment banking is, because it's this term that means everything and nothing all at once. People will tell you, oh, you need to get into investment banking, it's really good for learning in the day-to-day, without actually, digging too deep into what your life as an analyst at an investment bank actually looks like, or what the firm is actually even doing. So I'll pause there.
Deep breaths.
Deep breath. Investment banking at its highest level is advising on complex financial transactions. And you might say, Colin, that is insanely broad. You are correct. It is insanely broad. There's a lot of things that an investment banker can do, from researching public equities to advising on M&A transactions to advising for restructurings or other types of financial transactions. And so what I did was one of the specific services that investment banks will typically do. A Goldman Sachs or a Morgan Stanley will do all of the things that I talked about previously. They have different desks that do all of the various services that a company might need at the end of the day. Eris, where I worked, specifically does M&A advisory, so helping firms through sales processes, essentially. They do it specifically in the middle market, so roughly between $100 million to $1 billion of enterprise value. And they operate, by and large, for most of their transactions on the sell side. This is also a good time to dive into what's the difference between sell side and buy side. You'll realize we make up a lot of labels for things that are actually quite simple, just to make them sound complicated, but they're not actually that complicated.
Hey, these are professional services.
These are professional services we're talking about here. Buy side essentially means you're the one buying, so making investment decisions. A lot of the time, the actual investor. And sell side is, you'd imagine that means you're the one selling. Not always. Sell side services are very much, think of it as the broker in a transaction. So what we did at Eris was help prepare companies for these processes, advise them on how to go about finding buyers, running the process, and actually carrying through with the transaction, and what a fair value of what they could expect would be.
I was going to say it's a bunch of analytics along the way, right? To try and figure out how much the company is worth, how much the different parts are worth, how to get better terms, and what the terms mean to each company, stuff like that, right?
Yeah, so that's definitely part of it. And then what Eris spiked very high on was diving into actually preparing everything that you would need for a process. So,
that's right. I remember you doing a ton of spreadsheets, right?
Yeah, so we were working with, and the other way Eris was specialized was specifically technology companies as well, often software businesses.
Gotcha.
So retention of your existing customer base is really important for a software businesses. How expensive it is to acquire new customers, how to think about your projections going forward, and the actual financial model that underlies how a lot of potential buyers will think about your business. We were responsible for helping companies to prepare all of that so that those analyses were up to snuff with what an institutional buyer might expect from a company that's coming to market. And so that would take anywhere typically from 3 to 6 months. You'd go really deep, figure out exactly what makes a company tick, and then prepare all of the materials so that once you went out to market, and a buying process could be anywhere from a handful of potential acquirers to reaching out to over 100 to see who could potentially be interested in marketing the company more broadly. For me, practically, what that meant was I knew how to think about all these analyses. If we reached out to 100 buyers, I would need to think through the thought process for how 100 different investors thought about picking apart this company and the key questions that they would ask or potentially ask.
Right.
In a process. And so a big part of the job was taking yourself and putting yourself in the investor's shoes, a lot of different investors' shoes of what they would expect and what story they would look for to explain why the numbers and the actual analytics looked the way they did. And then to build those analyses. So it was funny. Exactly what I was doing was the flip side of the other side of the table, which is why the advice I got in the first place was, hey, you should really consider going into investment banking if you want to be an investor, because a lot of the work that you do at the ground level, at least, is very similar on both sides. It almost converges at a certain point in terms of preparing these analyses and understanding just what metrics matter for these businesses.
Gotcha. And when you were at OpenView, did you see any other paths that also looked interesting that people took to get from undergraduate finance to a higher level VC firm like that?
Well, it's funny if we want to dive into the
different, or any others that worked well.
Yeah, the different ways that you can find your way into venture capital. I would say it is one of the least structured potential career paths that you can have. So the amount of people that I found in the business that just had, talk about nonlinear, had just a wealth of experience across a bunch of different functional areas was one of my favorite parts about the job. I worked with people who had sales backgrounds, who had product background, who had engineering background, of just previously working in a lot of different areas of business and finding themselves wanting to abstract a layer higher and get into the actual investing side, and, you know, leveraging that knowledge of some specific area of the business to draw insights that could, you know, potentially drive either better investing decisions or a better ability to find investments. So it's probably a good segue into, what does a VC actually do? What are you responsible for? And I would break it up into a few different buckets, and people break it up different ways, but just to simplify it, let's break it up into 3. There is sourcing potential investments, so actually finding them and getting in front of the right people at the right time to have, call it a look at a potential fundraising opportunity. There is diligence, which is actually, once that investment is in front of you, digging deep, researching into both the market and the metrics of the business itself, figuring out, is this an investment that we would want to make? What would we need to see? Is this a partnership that we want to pursue with this specific founder at this specific time? Then third, the last bucket is, once an investment is actually made, honoring on the promise of the partnership in the first place of working with that founder through to whatever a potential exit would look like, whether that's an acquisition or an IPO, but the entire journey of what comes afterwards. And so those are the 3 main buckets. And so if you ever wanted to get into VC, it's really thinking through, what bucket could you help with? If a VC is trying to meet those goals, where can you step into that process and provide value is really the ultimate question. And so from my seat of where I started, the clear answer was that middle bucket that I was talking about, diligence, execution, really just helping dig into the research and decision-making process for, is this an investment that we want to make in the first place? And so that's exactly the role that I stepped into with OpenView in the first place. This was at the beginning of 2021, and they called the role a diligence associate. It was actually a role that hadn't previously existed at OpenView. I was the first diligence associate. Spooky. And the role itself in the first place, they knew they had a need for more of that analytical, you know, spreadsheet-based execution focused work, but they didn't really know exactly what the day-to-day responsibilities would entail. And so that's what I stepped into. They knew that, you know, ideally a tech investment banker would have worked with companies at that depth before, where they could hopefully flip to the other side of the table and help make investment decisions. But that was, call it my wedge into the industry, was to step in and help with that middle bucket.
Cool. Yeah, I think the diligence and the analysis of those companies is maybe, when you're at a lower level, what might stand out to the more senior people as being really important and really valuable. What do you think?
I would say all of the buckets are really important. And if you think about it, sourcing is a large bucket of value of how can you make the right decision if you're not even seeing the right companies. And I think this goes back to what we were talking about in the first place of, hey, there's going to be a subset of companies. Every company has a lot of potential and could be really special. But if you look back every decade, there's 5, 10, maybe in a, you know, extra popping decade, like 5 companies that really go and break through. They hit escape velocity is the term I like to use, of their exponential growth just continues until they hit that ridiculous scale where they can drive those power law returns. And if you can't find yourself in front of those companies, then it's going to be really hard to even make the right decision. You don't even know what you're looking at. So
what do you do early on to try and grab those first few companies, if you're looking at a spreadsheet of 1,000 companies? bring us through the first couple steps here.
Yeah, I think this is something where you've seen venture capital really evolve over the last few decades. I mean, this is probably a good time to jump to the history of venture capital in general. It's funny, people talk about it today like it's this institutional industry that has been around forever, but the industry itself is around 50 years old. It didn't really exist previously. Yeah. A lot of people point back to Don Valentine and Sequoia in the early to mid 1970s as, some of the earliest examples of what would become the more institutional venture capital industry today. Essentially, banks were not taking the risk necessary to fund these really high risk, potentially high reward business opportunities. And to start off with, because there was not a lot of available funding, you saw VCs getting really ridiculous terms on these types of businesses. One of Sequoia's earliest investments, Atari, was just, they acquired basically a majority of the company for, I think it was a few $1 million. And yeah, you can think about the potential return for something, but no one else was looking for them, right? No one else was looking for the types of companies that venture capitalists today get really excited about. I think, boiling it down to base characteristics, what you're really looking for is a really large potential market and an ability to deliver a good or service to that market that is very scalable. You can sell that software forever to everyone and make a whole bunch of money. A la Microsoft, I'm sure.
I was just thinking Excel.
Excel. Wow, there's a lot of people that could use Excel out there. We've figured out how to reach them, or at this point now they come to us because, everyone loves Excel.
Yeah.
And it's very cheap for us to deliver that. And what you've seen over the last few decades is the institutionalization of venture capital. And so now you have an increasing amount of money going after the same theoretical number of opportunities, and it creates a lot of competition to actually get in front of the right businesses. And the founders know that too. And so you can ask for higher valuations. There's a higher degree of predictability that comes along with it, which is where, back to the original point, sourcing is a very valuable bucket, because if you can find those entrepreneurs, get in contact with them, talk to them, and start to build a relationship, that is incredibly, incredibly valuable.
Would you say that there was a particular point in time when that started happening, or a particular company or transaction that caught everyone's attention and made it ultra popular in a short period of time kind of thing? Or was it slowly over the course of decades?
It grew, and you've seen venture capital roll with the ebbs and flows of business cycles, a lot like you would see in any industry. Really? Yeah. So, I mean, if you go back and you look at the 90s were a wild time. We've all heard about the dot-com bubble, but VC was a major, major part of that. If you look at it in retrospect, the base behind the dot-com bubble ended up to be correct. Of you have this massive market, the internet is incredibly high potential, and that is very much the way of the world of where it's going. The issue is, because everyone accepted that as an inevitability, they were underwriting to returns that were so far off in the future that they never actually got to realize those, which I think the best example of that is probably eBay. If you saw like the valuation that eBay hit early on before they even hit scale versus the market cap of eBay today, it's essentially the same. And so it's like, okay, so you were paying a 20-year forward valuation on a company. Like, everyone got so excited about the internet that they just assumed like the potential of these businesses was inevitable. And so for some of those businesses, they kept existing. They were sustainable. They stood the test of time, a la eBay. Some of them over-delivered on that promise, a la Google and the massive internet giants that you see today. And the ones that you will not hear about are the ones that did not deliver on that process, that do not currently exist today. But to get back to your main point of, how did this happen? How did it institutionalize? It was slowly but surely, but in some cases it accelerated, in some cases it pulled back. After 2001, you saw more of a heavy pullback before more dollars eventually flowed into VC. And the far more recent tangible example would be what we saw in 2020, 2021, which, in hindsight, everyone we'll call pandemic era hysteria, which, if you think about it, like parallels the dot-com bubble 20 years earlier. It was very similar. Basically, speculation led us to a point where people assumed that the durability of some of these companies was inevitable. And that was not necessarily the case. People got a little too ahead of themselves. And so you saw these eye-popping valuations for businesses that were not yet proven. And since then, you've seen a pullback, valuations come back down to earth.
Thank you again for all of that insight so far. Next, I'd like to talk a little bit about future of venture capital as an industry and any interesting details you might want to speculate on. What are your thoughts on the future of venture capital? Any possibilities of getting squeezed out by big private equity, or will they always find openings?
Yeah. Well, I think you saw in 2020, 2021, this idea of the crossover fund became very popular. Firms like Coatue, Tiger Global, Altimeter, jumping, and there were a lot more, jumping down market and going earlier and earlier into a company's stage of formation. Call it Series B, Series A, seed in some cases. And these are traditionally hedge funds that were diving into a new sector of the market, and those more higher risk types of investments that, eventually they were investing in pre-IPO anyway. They just followed those types of companies further upstage.
Further up the pipeline.
And you have poets and quants, I think is the phrase that people use a lot of the time. Of poets, the people that create theses that are more qualitatively driven of, hey, this is where the market's going. This is what a breakout winner might look like one day. More long-term, secular, thematic driven, and quants of people who look at numerical signals, call it website views or some sort of earlier predictor that could tell you
sales or email sign-up lists or something like that.
Yeah, but even more granular when it comes to the type of data that people are using now. One that has become quite popular is following on LinkedIn the types of people that are being hired. So if you could quantify the quality of a candidate based on their prior experience and how many of those types of candidates are joining an early stage startup, they theoretically have the most perfect information out of anyone of the potential of that startup, right? If you are hired by a startup, that is the biggest bet you can make personally in terms of investing for that specific company. You're investing your time.
Okay. So you're saying lean a little more into getting a sense of what companies may potentially break out in the future.
Yeah. You have higher velocity trading, more perfect information, because if you think about what differentiates public market investing from venture capital in the first place, it's this idea of unpredictability.
Yeah.
You're taking on more risk for more return. And the less risk there is, the more you can accurately predict what's going on. Theoretically, the less available return there is. So over time, you're going to see less return from venture capital in general as people get better at predicting what good looks like. And with less risk will inevitably come less return. People will be able to pay up higher valuations and actually know what's going to happen, as opposed to, which is why I bring up 2021, people were getting ahead of themselves of guessing what the breakout success would look like without actually seeing the proof points of what that is.
Perfect. Okay, great. Yeah, so that actually brings me right to the next question I had about good old interest rates, which were super low throughout 2010s into 2020 and 2021. I'm assuming that had some influence then on starting to dry up of free capital to throw into some of these companies. I'm wondering if you can tell us maybe a little bit about the timeline of like when interest rates first started going up. How long does that take to actually impact investments, and what kind of investments that impacts the most out of your different categories that you looked at?
Yeah, well, it's really interesting, and I will throw the disclaimer, I am not an economist. So highest level, interest rates affect the way that you discount future cash flows. And so when you think about low interest rates versus high interest rates, Who does that affect more or more acutely? Growth stocks, who you're relying on this idea of cash flows in the future, them continuing to grow, take more market share, and the cash flows that you'll eventually get from a growth stock as opposed to a dividend stock is further out. So the higher your discount rate, if you think about, for all my finance people out there, time value of money. So if you think about it this way, like you have a steady like telecom company, like an AT&T, and it reliably gives you the same type of cash flows and dividends year after year. And that dollar is today, and it'll be at a similar level in the future. Less of the valuation is due to growth, right? And then you have Tesla. And Tesla, people are valuing based on how it's going to keep growing so fast.
Once we go to Mars.
Once we go to Mars, forever. Like that cash flow in 20 years is going to be massive compared to what it is today. And the way you value, how do you think about the value of $1 in 20 years versus $1 today? You have to discount it back by some sort of rate of what your opportunity cost for that dollar would otherwise be. If I give that dollar to AT&T today, they're going to keep giving me dividends for the next 20 years versus Tesla. I'm not going to get those dividends until way down the line.
Right.
And I could take those dividends from AT&T and go do other things with them. So there's an opportunity cost to that capital.
Okay. So the differences in valuation are not due to how much it would take for the companies, broadly speaking. It's not due to the companies borrowing money. The difference in valuation is coming from how much an investor could get from just lending the money out to whatever versus how much they could get from investing the money in the startup.
Yeah, the core question is, what is the dollar 20 years from now from Tesla? What is that worth today? And what am I going to pay for Tesla today? And the answer to that question changes.
If there's fewer places you can loan out the dollar to make some money back on it.
Exactly. And so technology and growth stocks very much are more based off future cash flows. So when the Fed raises interest rates, that hits those growth stocks more directly, right? Like those are dollars from 20 years from now where instead of discounting them back at 5% per year, that's your opportunity cost. Now it's 10%. And that will drastically change with compounding the value of that dollar 20 years from now. So Fed changes interest rates. You have a technology company in the public market that was worth $50 billion. Yeah. Now you discount back all those future cash flows at a different rate. Oh, well, now all of a sudden it's worth $25 billion, which means you could enter at a much different price otherwise.
That makes sense.
To support that sort of outcome. Along with a lot of layered speculation on top of that of the certainty with which you think that company will get there. It was the interest rates combined with, we live in a world now where remote work is going to be the future and you will need these companies. And I think their chance of success is X percentage.
Back to that. Yeah, I'm not even getting into the strategy behind it.
Yeah, exactly.
I was just looking at the I guess valuations overall.
It was speculation plus interest rates that really led to this bubble.
Right. And then in terms of lag, did you see any sort of lag with that? Like if interest rates got raised today, did the valuations immediately change like this afternoon? Would you be looking at different valuations for a company?
There is definitely a lag, and I would say a good rule of thumb to think about it through is the lag and the effect that the public markets and these more, short-term rate decisions have is felt sooner the closer you are to that actual exit event.
Oh,
so
interesting.
Series E, Series D, those later stage companies, because they're so close to that actual exit event, will be far closer to public market multiples. Mm-hmm. And you almost have to unwind that the further back you go.
So it's not only due to the interest rate today, but you're also estimating the interest rate over the period of time that you're giving the companies money. Is that right?
There's a lot of speculation that's involved. Okay. Yeah. So it's a series. You fund a Series Seed company today, you're not going to see any return from that investment theoretically in a successful case for maybe a decade.
Right. Okay. That makes sense.
So yeah, it's felt less acutely at that stage. Rising interest rates will impact later stage companies more than they will affect early stage companies, all else being equal.
Okay, great. So then I think the Fed's already been pretty public about this so far, that they're looking to drop rates, small amounts, but small amounts, a handful of times over the next 12 months or so. Do you see that as kind of a net positive, net neutral? Where do you see that? How do you see that impacting VC overall?
It's net positive, and if I was being optimistic, I would hope to see that the behavior we saw in 2020, 2021, because a lot of the behavior you saw was not just related to interest rates, but also just speculation in general, that you will see a little bit more discipline from an investment point of view compared to what you saw then. And if they're not grounded in reality and you can't find someone to help you exit that you took at a similar or higher valuation, then that's not an investment you should make. Really what you saw during the wild times, you'd see companies without any revenue raising at $300, $400, $500 million valuations. And the question was, what reality do you have to back that up? And the answer was, you really didn't have any in a lot of cases, but you used the behavior of your peers to justify that investment. If someone, when that company gets to 5 million of revenue, will buy it from you at $1 billion, then maybe you can justify that. Now that the brakes have been tapped a little bit, I think, the hope of the Fed too is that you see a little less of the behavior that's typically associated with very hot economies, of that speculation piece, and assigning a higher degree of certainty to an event that you don't necessarily have the data points to back up as an exit.
Yeah, no, absolutely. That makes sense. Okay, great. Talked a lot about venture capital here and companies in general. Back to the personal side for a second. Where do you see your career going in the next 5 to 10 years? Where do you see the next handful of steps here for you?
Yeah, I mean, all things considered, I'm still pretty junior in the sense of things in venture capital. I'm still very much learning a lot about the industry, how it works. Obviously, if it's not clear, there's a lot of history here and a lot more to understand about where the industry's going. And I'm still pretty much in the early stages of that. I've been doing VC for 3 years now, but it's something I want to continue doing for the next 5, 10, 15, 20 years at least, just because there is so much more to learn. And there's so much that you need to know to do the job holistically across those 3 buckets that I laid out earlier of sourcing, diligence, and, helping partner with these companies after an investment. So just continuing to kind of be an apprentice, learn behind investors that have seen more cycles than me, that that can teach me kind of how to perform the craft, is what I'm looking to do for probably the next decade at least.
That's awesome. Great. And then do you think you ever see yourself at a startup itself, anything that's from seed stage to Series D or whatever, any number of employees or revenue? Just kind of curious. Do you ever see yourself making the leap from venture capital to working at one of these places that is looking for venture capital funding? Yeah,
I definitely could. There's a lot of value in, it's called operator experience, from people in the VC world, of people who have been there and done it and have the empathy for the founder in the seat that you're working with. At this point, at least for the near future, I think there's just so much more that I still have to learn on the investing side. But no, definitely something I could see myself doing at some point. And that operating experience can come from a lot of different directions too. There's different levels of involvement you can have with different startups, but it's definitely something that I personally value highly and would like more of as I continue through my career.
Cool. Yeah, I like that a lot. Did you ever consider any alternative career paths in a serious sense? I know we joking about net fishing earlier, but I know you love fishing. Absolutely would have had the chops for that. But back in the real world, anything else that you might have, if things had gone slightly differently, you may have found yourself doing now instead?
Yeah, I mean, I've I'll repeat myself again. It sounds linear when I go back through my background and draw the straight line now of, and then I did this, and then I did this, which naturally led me to this. But at every crossroad, there were half a dozen other things that I could have done. Like I said at the beginning, I was messing around landscaping in my hometown at the beginning. There's a world in which I'm still doing that, and I continued pursuing that, building out that business. I think that would have been a lot of fun. To your point, charter fisherboat captain is my backup
End
plan.
goal.
My end goal. If one day I can find somewhere sunny and warm, just out there on the high seas with a few fishing poles and a Corona, that sounds pretty good. That sounds pretty good too.
I like that plan.
Send
me an invite.
At one point, I thought I was going to be an accountant. At another point, I was very close to being, just a more general wealth advisor. We didn't touch on it during this time so far, but I also worked at a hedge fund at one point earlier in my career and realized there were aspects of that I didn't like as much. So there's a lot of different things I think I could have done, but I think just the exposure I had to different types of companies, ideas, really led me to kind of wander down the path that I have so far. So I expect more wandering in the future, but so far I like it.
Cool. All good answers. So yeah, thanks again for your time.
Yeah.
Appreciate it. Anything else you want to say to the crowd, the people?
No.
I'll take it.